Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Cnooc Limited Annual Report. Cnooc Limited is a global energy company that provides a wide range of businesses and services. At its core, the company engages in the exploration, development, production, and sale of crude oil and natural gas worldwide. This includes producing offshore crude oil and natural gas primarily in China's seas. In addition to its core business, Cnooc Limited also offers various other services. These include the sales and trading of petroleum and natural gas, as well as oil sands exploration, development, and production. The company is also involved in the exploration, development, and production of unconventional natural gas resources onshore in China. Furthermore, Cnooc Limited has interests in various oil and gas assets across multiple continents, including Asia, Africa, North America, South America, Oceania, and Europe. This global presence allows the company to diversify its operations and tap into new markets. Overall, Cnooc Limited's diverse range of businesses and services make it a significant player in the energy industry. The company's activities also include shale oil and gas activities, which are becoming increasingly important in the global energy landscape. With its extensive experience and expertise, Cnooc Limited is well positioned to capitalize on emerging trends and opportunities in the energy sector. Cnooc Limited market capitalization of $1,431 billion is significantly larger than the average industry peer of roughly $0 billion. This shows that Cnooc Limited holds a significant advantage in their industry. Cnooc Limited trades at a lower price-to-earnings ratio of 10 times and a higher price-to-book ratio of 1.52 times relative within the industry. While the stock does not screen as absolutely cheap, mixed valuation signals relative to industry peers prevent a definitive conclusion. With the broader industry trading at lower valuation levels, this may reflect transitional pricing dynamics rather than clear mispricing, warranting further analysis of earnings quality, growth sustainability, and balance sheet strength. The balance sheet appears very conservative, with liabilities representing only 29% of total assets. While this indicates low financial risk, investors should examine the composition and quality of the company assets to determine whether they justify the current valuation. Average liabilities have increased consistently as the company expands. Importantly, both assets and shareholder equity have grown at least 20% faster than liabilities, indicating that the business is expanding substantially and generating value after covering its obligations. Shareholder equity has expanded consistently over the past 5 years, with growth supported by rising operating income. This suggests the company is profitable and financially sustainable. The share count has increased over the past 5 years, while revenue has continued to grow. This suggests the business may rely on shareholder dilution to fund expansion. Investors should closely monitor whether growth can eventually be sustained without dilution. The company have a dividend yield of 5.02%. The income statement shows that the company have been growing its revenue annually and the operating income have been increasing. This shows that the business model works and the business is expanding. The primary drivers of revenue growth or decline can be identified through a review of the key factors that have impacted an organization's financial performance over a specific period. Revenue decline is primarily driven by decreases in oil and gas sales, marketing revenues, and E&P segment revenue. Specifically, oil and gas sales decreased by 5.7%, while marketing revenues declined by 2.8%. The E&P segment also experienced a significant decline of $16,942, 16.1%, from 2024 to 2025. On the other hand, revenue growth is attributed to increases in trading business segment revenue and revenues from PRC customers. The trading business segment saw a 1% increase in revenue, amounting to $3,295. Additionally, revenues from PRC customers accounted for 64% of total revenues and increased by RMB 29,601 million. Some factors have had a mixed impact on revenue growth or decline. For instance, the increase in oil and gas sales volume was offset by a decrease in international oil prices. Furthermore, an increase in interest income due to changes in interest rates and bank deposits contributed positively to revenue growth, with a 10.5% increase observed. The company's financial performance indicates a consistent generation of positive operating cash flow over the past 2 years. In 2024, the company generated RMB 891 million in operating cash flow, while in 2025, this figure increased to RMB 9,042 million. This trend suggests that the company is effectively managing its operations and generating sufficient cash from its core business activities. The company's debt level has undergone a notable shift in recent times. While non-current liabilities have seen an increase of 7.5%, loans and borrowings have actually decreased by 4.1%. This contrasting trend may suggest that the company is opting for alternative financing methods or restructuring its debt obligations. As a result, interest expenses are likely to be affected, although they are not explicitly stated in the provided information. Nonetheless, it can be inferred that any changes to loans and borrowings will have an impact on the company's interest expenses. The company's performance varied across different segments and regions. Unfortunately, three key areas underperformed: exploration and production, E&P, trading business, and corporate. These sectors saw a decline in revenue between 2024 and 2025, indicating a need for improvement. A closer look at the data reveals that these struggling segments were unable to maintain their previous year's revenue levels. This trend is concerning and warrants further analysis to identify the root causes of this decline. The company has made strategic decisions regarding its business operations. In terms of growth and expansion, the company has engaged in value-driven acquisitions. This approach allows the company to acquire businesses that align with its goals and values, potentially leading to increased revenue and market share. However, it appears that the company has not pursued divestitures at this time. Divesting certain assets or business units can be a strategic move to focus on core operations, reduce debt, or reallocate resources. The absence of divestitures in the extracted summaries suggests that the company is committed to its current business strategy and does not see the need for significant changes through asset sales. The company's financial performance over the past 2 years has been marked by a commitment to rewarding its shareholders. As stated on page 13 of the report, dividends were paid out in both 2025 and 2024. This indicates that the company has prioritized returning value to its investors through dividend payments. That concludes the financial summary for Cnooc Limited. Feel free to comment below, and I will be happy to answer them when possible.